Welcome to Views from the North, a Canadian rates and macro podcast. This week I'm joined by Chris D'Onofrio, one of our Canadian dollar swap traders. This week's episode is titled, Is it cheap enough yet? I'm Ben Reitzes, and you're listening to Views from the North. Each episode I will be joined by members of BMO's FIC sales and trading team to bring you perspectives on the Canadian rates market and the macro economy. We strive to keep the show as interactive as possible by responding directly to questions submitted by our listeners and clients. We value your feedback, so please don't hesitate to reach out with any topics you'd like to hear about. I can be found on Bloomberg or via email at benjamin.reitzes@bmo.com. That's benjamin.reitzes@bmo.com. Your input is valued and greatly appreciated. Hi, Chris. Welcome back.
Thank you.
What the listeners out there don't know, or maybe some of them know, only a select few that converse far too often, or maybe just the right amount with our sales force. Chris and I just drove back from New York yesterday. It's currently Tuesday, so we're recording a day early because I have a golf tournament tomorrow. Save your shock. Pretty much every flight. I'm not even sure if it was all flights out of LaGuardia in New York, or at least just all Air Canada flights out of LaGuardia and New York, for that matter, were canceled late yesterday, or not even late in the afternoon. And so Chris had a brilliant idea that we should hop in a car and drive back due to our commitment to the Bank of Montreal. Exactly. And
I'm not sure that I was right. I'm not sure that was the right call, but here we are.
So we got home at very late, and now we're recording a podcast the next day. Hopefully we make it through here and are sufficiently entertaining for all the listeners out there. So
such a glamorous lifestyle.
So in New York, one of the themes that we talked about was the cheapness of the front end, and this is before CPI. I guess after today's move, you'd make that point more adamantly, or maybe are you more cautious now because the data have really gone the wrong way? I guess I
would say less because of the data and more because of the price action. Like, truthfully, to me, I'm surprised that we've even gotten to this point. I thought the risk return looked good, prior to today. So call it 10 basis points ago in the 6 to 18 month really part of the curve. So I guess you can blame it on positioning, but I am a little bit at a loss for why we were allowed to get this cheap off of a number that was basically on the screws this morning. I do think it doesn't make any sense here. I am still adamant that being long that part of the curve is the right trade. I just think you might need to be a little more cautious about the way you layer into it, given the positioning and given what the price action was on the back of this morning's print.
So one of the things I said yesterday was, we're not cheap enough. We're cheap, but we're not cheap enough. Now, after today, and I mean, I'm surprised too. I mean, I guess the fact that there were stop outs today was a bit confusing for me.
I agree.
Because Friday's number should have probably stopped everyone out that was long, including me. So that was unfortunate. But it didn't, and obviously, given today's move. But I think this was less front end and more across the curve. It felt like 10s also, futures got destroyed.
We saw some stop outs in the belly in various different forms for the last couple of days. But I don't really have a beef with the curve steepening, to be honest. We talked about this a little bit yesterday.
I like
looking at a historical chart of 1 year, 1 year, 5 year, 5 year, and seeing 10 years ago it was plus 200. I don't really have a reason or a good reason for why that couldn't be the case again anytime soon. It's not really my issue. My issue is that the shift wasn't parallel, but it was far too close to parallel today for what I think the next year or year and a half looks like policy-wise, or could look like policy-wise, right? I mean, there is a decent amount of positive slope in 2026, which given for a number of reasons. First of all, given the global backdrop of where rates are with the US and where it looks like policy is heading with the US and other currencies, other developed currencies, let's say, it's very difficult to see a world in which both of those are correct current pricing, right? If the US is cutting 100 basis points next year, I don't see Canadian growth in a vacuum being strong enough that we can consider hiking.
Well, I can provide a counterfactual there if you'd like.
Sure.
So I think it's May, Powell will be done as chair. A new Fed chair will come in. President Trump has made it abundantly clear that whoever he picks will be cutting rates immediately and potentially aggressively, no matter the backdrop. And so you can have a world in which the U.S. economy is in pretty decent shape. I don't know if it will be, but it's not impossible. And growing at, 1.5% to 2.5%, somewhere in there. It's a wide range, but somewhere in there. And aggressive rate cuts, which are that's positive for Canada at the end of the day. So that, I can build a scenario where the bank would have to hike, I'm just super skeptical that that's a likely outcome.
And I would say, I want to say two things about that scenario as well. Like, assuming the data looks exactly the way it does now in 8 months, I guess, something like that. And this scenario does play out in the US where somebody just comes in and slashes rates. Like, one, for that to be positive for Canada will take some time. It's not going to be
Yes.
overnight positive for Canada.
Correct.
So that doesn't really change the fact that our growth isn't where we need it to be, and our unemployment is still quite high, and a number of other things. And two, I think the Canadian front end, you can't have zero probability of cuts. You can have a small probability of cuts. I don't think you can have zero probability of cuts if the U.S. slashes rates 100 basis points overnight.
Yeah, I mean, immediate, and the initial knee jerk would also be that Canada price is more. Yes.
Agreed.
Yeah,
Agreed.
Yes.
So yeah, like obviously it's a big risk return thing right now. I just, like we've said, the problem isn't necessarily the whole front end, but it's, I think, that particular part of the curve. The fact that there is a non-trivial amount of probability mass of hikes being contemplated in the middle of next year doesn't make any sense. Like, 2-year rate is whatever, very close to 275, so very close to overnight. Do I think that every contract in the next 2 years needs to move in parallel? No. Do I think that if the reds, or the early reds even, were to rally 10 or 15 or 20, probably closer to 20 basis points, and the front two meetings or the front three meetings didn't move because all of a sudden we're realizing, hey, maybe this inflation is sticky, maybe we're not going to cut anytime soon, but there needs to be some sort of a probability that this is just being kicked down the road, and we're still going to have a growth problem, and maybe inflation comes down slightly, or we're still going to have high unemployment, etc., 6 months from now. And then, okay, they need to cut 25, or they need to cut 50. God forbid it's 50, right? The bar is so low right now. There is zero a year from now, right?
Yeah.
When it was 275, there's zero.
And
So,
they've told us that they're biased to cutting generally.
yeah, agree.
So that part does matter. I agree. I can easily see a world where they're on hold for the rest of this year, and then they actually cut in the first half of next year.
Yeah.
And
There needs to be some sort of probability that I think priced into the curve.
The positive slope in the first half of next year in the core futures doesn't make a whole lot of sense to me. I'm totally, very much agree. Does that mean it's going to reverse tomorrow? I doubt it.
Cool if it did.
I mean, fine, but I highly doubt it. You need a catalyst there,
Yeah.
and there isn't one. Not for, it's going to be weeks. The data flow is pretty much nothing. Like, there's retail sales will be out next week. The business outlook survey will be out next week. I don't think either of those will move the needle for the market unless the business outlook survey is a massive outlier. But it's not going to be worse than the last one, I don't think. So that makes me, skeptical that I can really move the needle more toward more cuts. And then after that, you have GDP at the end of the month. It's monthly GDP, and it's for May, and that's far enough back that I don't think anybody cares. You will get a preliminary on second quarter, which I'm assuming will be small negative. So maybe that helps a touch, but the flashes have been pretty bad at predicting where things are going to come, that I think people are a little more skeptical on that. And then after that, it's next month. It's jobs and inflation, and then actual second quarter GDP. And then those three, I think, are real meaningful numbers that can move the needle, but inflation probably matters most. Like, that's probably one. And then jobs are kind of secondary. And then GDP, I actually might even put GDP above jobs next month, just because it's the quarterly number, and the bank puts a ton of emphasis on the quarterly numbers because that's what feeds into the model. And so if you get real weakness in the second quarter, which I think you're going to get, I would guess at this point, from the way that I've seen people forecast for 10 plus, 15 plus years, that it will come in below expectations. We'll see what expectations are, but that's just my guess at the moment. And jobs, we already know the labor market's weak. Like, unless you get unless the unemployment rate goes down again, all right, then things have changed a little bit, and maybe things aren't as soft as we think, and so on and so forth. But at the end of the day, if CPI, if core inflation more precisely, doesn't slow a lot, I don't know why they would even consider looking at rate cuts. And then the question is, okay, well, if that's the case, well, when/why is it going to slow? I suspect that the current inflation that we're seeing is more a function of the past growth that we had in Canada last year. We had every quarter last year was above 2%. That is all pretty solid. I mean, there was an output gap at the time that was closing, but still, maybe inflation's a little bit more, maybe it reacts a little bit quicker now to growth in a way that it didn't before, because inflation is not as sticky as it was, because we've had this inflation period. I wouldn't rule that out. And then maybe what we're experiencing now is that like the inflation left over from that period, and the weakness in growth is going to spill over to inflation toward the end of the year. And on top of that, you get good base effects in the fourth quarter. So that kind of feeds into that early 2026 rate cut world.
It's definitely a real scenario. I don't know if it's the maximum likelihood, but it's a real scenario for sure. I have a question. Since people, I mean, the housing market is obviously always super topical in the summertime. It's the flows that we've seen have been underwhelming, I would say, on that front from mortgage hedging activity. But at what point do you think we can say that enough of the population has felt the impact on their wallet of a more expensive mortgage and sustained higher rates, and that is reflected in the data in terms of, let's say, CPI as a proxy? Do you think we're already there? Do you think, and a lot of people are talking about a lot of refinancing coming up this year from 2020, so that's the thing. Do you think we have to wait for that? Do you think it's beyond that? At what point do you think it's safe to say, okay, that's not as much of a headwind as we thought?
I've been skeptical of that from the first time it started, pretty much. I mean, the initial wave of refis with much higher rates were a headwind, and they still are a headwind. I'm not going to debate that point. Like, there's no denying that. But the extent of the headwind's the question. And there was plenty of people out there being like, this wall is going to destroy Canada, and we're going to. And I was like, hold on a second. First, consider what share of the population even owns a home and has a mortgage. And I have the numbers on my computer, but it's like 35-ish.
I remember you telling me when
in that ballpark. This, yeah. So you have renters and owners without a mortgage is the rest of the economy. So that's a lot of people. And then it's like, of that 30 whatever percent, high 30s% that own a home and have a mortgage, what share of them are facing a reset? And so there's a decent chunk between those in a variable and those resetting over the next 2 years. I get 60% between the two. And yeah, there's for sure going to be a payment shock. There's no real, I'm not debating that. I don't think that's a question. But the question then becomes like, okay, how impactful is that at the end of the day, and how unprepared are people for it? Rates have been high for years now. They know what's coming. It's not as if they're spending literally every single dollar on Monday, their mortgage resets on Tuesday, and then all of a sudden they're bankrupt. Like, that is not, people are not stupid.
No, I hear that. My question is more like, look, I never thought, and we talked about this, I never thought it was going to be all of a sudden sticker shock and the economy tanks. My question is more like, if, people were treading water for the first few months of their refinancing and then it slowly starts to eat away into it, is that a factor? And can we say we're past that point where it doesn't actually matter that much? Or
I don't think it works that way. So the way I like to prefer to look at it is like, okay, well, you got this mortgage 5 years ago. Your income was X and you paid Y percent, whatever, 15, 20% of your income to the mortgage, which is a lot, by the way. Over those 5 years, your compounded income growth is somewhere in the 20 to 30% range at the low end.
Okay.
And so even if your mortgage payment goes up substantially, like, you have cushion there. The problem is, like, your spending growth is definitely curtailed. Like, there's no doubt about that. Yeah. So like for a full year, your spending growth might be zero. It might even be slightly negative for a year because you have to redirect spending back to your mortgage. But that's what it is for a year, and then you restart. And so we've been working through that consistently. Like, this has been happening for over a year. And all the resets that have come so far, that is what people have had to deal with. The resets haven't been as big. Like, the jump in the mortgage rate hasn't been as large. I think the bigger ones are starting now. 5 years ago, it was 199 on a 5-year for those that refied in the spike in activity just after the pandemic. And now it's 4-ish% either side of that, depending if you're insured or not. And yeah, there's a payment shock. Of course there is. And it's a big payment shock. But income growth, like the macro data, suggests that it is manageable. There will be circumstances on the micro where it is not, but I think that's not the norm. Those are more the exceptions. And quite frankly, from everything I understand, like, the financial sector in general prefers to work with people. No one likes to take a house away, especially not in this market. Like, this is not a good market. The housing market is not in good shape. And all the people crying out for more supply for the past number of years maybe should rethink their argument here, because home prices are going down. Is that a sign that there are too many homes or not enough homes when prices go down? usually it means there's too many. Or they're just too expensive for what we have. The stock is too rich, which I think it is. So we'll see where we go. I'm not overly concerned about that headwind. Maybe it's slightly stiffer through the back half of the year because you're having that 2 percentage point jump. Maybe. But we're also going to get fiscal stimulus. We might be getting it now.
There's something to be said about the lag in which.
Well, we'll see. Like
all
this fiscal stuff is such a question mark. It's kind of frustrating, honestly. I mean, the government has said a lot of good things. I'm probably as optimistic on the government as I've been in a very, very, very long time. But that's mostly because they've said the right things and they've kind of started doing the right things, but we haven't seen any follow through yet. Like, there's no pipelines being built. There's no road to the Ring of Fire in Northern Ontario. There's no natural gas export plant being built anywhere. Like, there's none of that stuff has even started to happen yet. So when we get a little bit more action on that front, great. I'm very eager to see what the budget holds in the fall. I think the government has the potential to be kind of a game changer in this case. And I hate saying that because government just should never be that way. But the regulatory burden on Canadian firms and Canada in general is so high that if we can actually just get out of our own way for a while, we would maybe be shocked at what we can do.
Yeah.
Canada looks so much better. It'd be crazy.
Yeah. I mean, I would still argue that that's more of a, pricing-wise, more of a curve steepener than anything, given, like you said, if you want to build a pipeline or you want to export natural gas, it's going to take years.
I'm all for steepening, personally.
Rather than a net hit to the market overall. But yeah, I hear you. I think that should be meaningful if it goes according to what they've been saying.
If is the problem. Like curve-wise, I'm all for steepening. I don't. It's hard for me to see the curve, especially from here, like given where the front end is and where the risks are for bank policy. Like I just can't see them hiking for at least a year unless something wild happens. And even in that case, you'd probably maybe argue that curves would probably still be steeper because you'd probably need to price in higher long-term rates in that case. But I just don't know how the curve isn't steeper 6 months from now than it is now.
I agree with that.
And that's I've been thinking that for ages, and nothing has dissuaded me from that. And similar in the U.S. And I mean, the U.S. has more stuff going on. I mean, you got Powell facing threats to get fired and speculation he might resign. And that, oh my God, I can't even imagine what would happen. Like,
wow, the U.S. front end would rally 50 basis points in a week, wouldn't it?
Yes, but the front end is the easy part. The long end is the hard part.
10s wouldn't move, I think. Yeah.
And 30-year yields might just absolutely explode higher on effectively the government messing with the Fed and ruining any credibility that they might have. And we just went through this massive inflationary period, and there will be exactly 0 people out there with confidence that the Fed would face inflation again if it came. And what does that do for term premium and inflation premium out there? I don't want to know. I hope we don't get to that point, but I mean, we might get there anyways next year when whoever becomes the next chair. Like, it might come anyways. There's nothing you can do about it.
Maybe the market's discounting that a little bit, right? Like, even whether it's a month from now or 8 months from now, like, is the outcome not going to be similar?
Well, like, it depends on who gets chosen, one, and once they're chosen, the path that they select. Like, you can pander as much as you want to the president before you're chosen. Once you are theoretically independent at the time. And then you're going to face a barrage of, insults, effectively. And your ability to withstand those would be the question. But I could see someone coming in, cutting 50 basis points, and then being done. And then being like, yeah, okay, that's enough for now.
Oh, I see what you're saying.
Yeah, just to be like, okay, this is what I told you I would do this.
Yeah.
Exactly.
Okay.
I told you I would do it, and now we're done, and that's it. And we'll see where we go. We'll wait 6 months because things are actually okay. Rates are no longer net restrictive, which is, I think that's an important part of all this. I think if the Fed can pull itself to neutral, which is part of why I think a number of FOMC members are kind of leaning toward cuts. Once they're neutral, then it's a different argument, I think. I mean, cutting 3 percentage points is radical. But a few cuts is not a big deal, I don't think, at this point. So thankfully, we don't have to deal with that.
Yeah, not yet.
Not yet. We do get a mandate renewal next year. But for the bank in 2 weeks, this is a quasi preview episode because, again, I'm out next week, so can't do that next week. Nothing expected.
I do have one more question that I wanted to ask you on that front. I know you told me earlier that you don't think there's much that they can say that will actually move the market.
There's always something, but I don't think they will. How about that?
Yeah, what I was going to say is, how severe do they need to be? Because the rhetoric is always, modestly dovish. We want to cut, but we can't at this point type stuff. And we've said that for months now. But where do you think the bar is for that to actually impact pricing? Like, what things do they need to say 2 weeks from now that actually induces a sustainable rally in the first, whatever, 1 to 3 years of the curve?
It might not be what they say, but what they publish. So it's an NPR meeting. So we get a fresh monetary policy report with new forecasts. And if they're forecasting a material deceleration in core inflation, then like we'll just be watching that. And then if it evolves that way, then they'll have a much freer hand to be cutting. So that will betray where they want to go, I think. I still strongly believe they can't cut until inflation slows. Even if spot inflation is not kind of what they historically have looked at, because they miss so badly, they have no choice. Otherwise, they risk their credibility. Like if they're wrong, they're done. So they can't be wrong. And so the only way to make sure you're not wrong is to actually make sure that inflation is slowed. And so if their forecast has inflation slowing meaningfully enough, being like, I don't know, from here, get it to 2.5 in the first quarter of next year, which is very doable. And that's their forecast. Then like you're just watching that number. And we'll see I think the growth numbers are still like Q2 will be pretty bad. Q3, I have trouble. I think it won't be terrible, but I don't think it'll be good. And Q4, at this point, I have no idea. We'll see what the budget looks like and how quickly fiscal ramps up and where we are in trade negotiations by then. But you probably still have an output gap, which is putting more downward pressure on inflation. And that's how they look at stuff. So if you still have that output gap backdrop with disinflation, which is slowing inflation, not falling prices for those out there, that opens the door for them to be easing, which goes back to that 2026 rate cut scenario, which it's like is not bad. The issue is inflation, and it's not going to be one report; it's multiple reports, and like because the base effects for Q3 are not favorable. Let's say it's going to be hard for inflation to slow a lot, and then Q4 looks a lot better, and then you're into next year. You're into January pretty quick. So, I mean, the more I say it, the more I like it. I'm convincing myself, which is never good.
We've got a good confirmation bias thing going on in this episode.
It's not great, but I only thought about it like pretty much today, this way. So we'll see how this goes. I mean, the data have tended to surprise pretty meaningfully in any direction through the course of the year. So I'm open to being wrong on this, but they're 1 year. That looks all right. I just think you wait for a catalyst. Wait for that. It has to be a data point to turn things, because Canada just tends to keep pushing in whatever direction it's going until there's a reason to stop. And part of that is just futures and machines driving things, and they just keep going. And we've seen that through the year. Like it's been a number of times. It's like, how do we keep moving? How do we keep richening? And early in the year is, how are we consistently richening all the time with nothing going on? And then it's, how are we consistently cheapening all the time with nothing going on? And there were catalysts to drive both of those. And so now we're still cheapening, and until there's a catalyst to change it, I think you just kind of stay a little bit patient. Maybe start to add small positions, I think is kind of reasonable. But I don't think you have to do it immediately. Like there's no near-term catalyst at all. So maybe wait for the bank to come and go, and then start ahead of jobs. And then maybe add a bit more ahead of CPI, because who knows which way those are going to go, and then a little bit more ahead or even after GDP, and then kind of go that way, so on and so forth, a little bit at a time. What else do you like other than the front?
I mean, we talked a bit about steepening. That makes sense. We can talk a little bit briefly about swap spreads.
Good, because we're almost out of time.
Yeah, briefly. I mean, obviously we've kind of gotten cheap and stayed cheap across the curve. I think the front end is probably near its limit around these levels. 2 MMS is now around 15 and a half basis points. I think much cheaper than this. There's a lot of appetite, just because I think there's a decent amount of cash out there to deploy in short-term paper among a lot of different real money guys domestically. And also because, I mean, we talked about this briefly yesterday, there's still talk of the bank.
Oh, they are going to buy T-bills at some point in
exactly.
Q4, so that certainly helps, yes.
Yeah, so that kind of maybe is not a catalyst for them to go up, but certainly prevents them from going down further. I think further out, the fiscal story has somewhat become priced in. Given that we're going into this kind of quote-unquote wall of refinancing mortgages, maybe you don't want to be short fives, but there's probably not much of a resistance for 10s and out to go lower, given that, we're expecting a ton more bonds if government spending is what everybody thinks it's going to be 6 months from now. So outright levels are okay to me here. I think net the spread curve probably continues to flatten. That would be
that's been my thought for a while.
Yeah, I mean, we've been talking about this for a couple months, but I don't see a reason for it to stop here.
I agree. And we got fresh mortgage data yesterday, mortgage originations, and there's a further uptick in 5-year originations and 3 to 5 years. So that part of the curve is seeing more activity than it was, and variable has come down. And I think that keeps going through really, I think it's through October is the refi wave. By then it will be mostly done. I think you'll see those people are mostly in 5 years. So
yeah,
I would guess they took the 5-year because that's where they like to be in the first place. And after seeing what rates have done over the past number of years, they'll probably lock that down in the 5-year area or 3 to 5 year area. And it's going to weigh on the 5-year sector. I mean, given what's happened over the past couple of 3 days, really, like 2 size 10s, just selling 5s on the curve, probably not the worst idea. If 2s are kind of limited in how much further they can sell off.
Yeah, I think that's right.
10s have also gotten destroyed. Like, I don't know. I mean, that's my problem.
Right?
It's
2 5s is what you want.
Yeah.
Go back to steepening.
That's
yeah. I think you're right.
Might be 2 size 10s. It might just be 2 size. That's fair.
Yeah.
10s. I'm trying to think of the curve in my head. I'm like, 10s got killed today. Maybe that doesn't quite work, but at least something to think about. Chris, thanks for coming on the show. Thank you for driving me most of the way home from New York. Yeah. I did do a small stretch, but Chris is a younger man than I, so I let him power through.
Let's never do that again.
I agree. But let's do this again at some point.
Absolutely. Thanks again.
Thanks for coming on. Thanks for listening to Views from the North, a Canadian rates and macro podcast. I hope you'll join me again for another episode.
The views expressed here are those of the participants and not those of BMO Capital Markets, its affiliates, or subsidiaries. For full legal disclosure, visit bmocm.com/macrohorizons/legal.